Hello and welcome to our weekly market roundup, your one-stop source for the latest in global market trends, key economic insights, and top financial news. I'm your host, Daniel, bringing you the highlights and the happenings from around the world. Let's dive into the numbers and stories that moved the markets last week. Global equity markets had a mixed week. U.S. stock indexes ended mixed in a week of light trading before the Labor Day holiday. The S&P rose 0.24% and the Nasdaq Composite lost 0.92%, impacted by a sharp decline in NVIDIA's stock, which dropped nearly 10%, erasing roughly $300 billion in market value. European stocks continued their rally, with the STOXX Europe 600 index rising by 1.34% to a record high. The drop in inflation across the Eurozone supported expectations for an ECB rate cut in September. Major indexes, including Germany's DAX and Italy's FTSE MIB, also posted gains. The UK's FTSE 100 index ended 0.59% higher. Japanese stocks recovered earlier losses, with the Nikkei 225 and TOPIX indexes both posting gains for the week. This recovery followed concerns about U.S. growth and the unwinding of yen carry trades earlier in the month. Chinese stocks fell as disappointing corporate earnings and reduced growth forecasts weighed on sentiment. The Shanghai Composite Index and CSI 300 both declined, while Hong Kong's Hang Seng Index gained. The JPY weakened against the USD, with the USD-JPY pair rising by 1.28%. The GBP saw a decline, losing 0.63% against the USD. The euro struggled this week, dropping by about 1.27% against the USD. Oil prices experienced another weak week, culminating in a 3% decline on Friday. WTI crude closed at $73.55 per barrel, marking the third consecutive weekly loss. Brent crude also fell, ending the week at $76.93. For August, both benchmarks declined by 0.66%. The gold price continues its roller coaster ride, and after a profitable week, it has once again fallen to the $2,500 per troy ounce level. Key economic reports shaped market sentiment, with the core personal consumption expenditures price index rising 0.2% in July, aligning with expectations. Year-over-year inflation was slightly below consensus at 2.6%, signaling that inflation remains near the Federal Reserve's target. Additionally, personal income increased by 0.3% and spending rose by 0.5%, reflecting the resilience of U.S. consumers. The Commerce Department also revised its Q2 GDP growth estimate upward to 3.0%, driven by stronger consumer spending. The housing market continued to struggle, with pending home sales falling 5.5% in July, reaching their lowest level since 2001. The yield on the 10-year U.S. Treasury note edged higher, as market expectations for a significant rate cut by the Federal Reserve in September diminished. Eurozone inflation fell to 2.2% in August, close to the ECB's target. However, services inflation ticked up to 4.2%, raising concerns among some policymakers about cutting rates too soon. While Eurozone economic sentiment improved, Germany's Business Climate Index dropped, reflecting growing pessimism among German companies. The UK housing market is showing signs of strengthening. Tokyo's core CPI rose more than expected in August, reinforcing a hawkish outlook from the Bank of Japan. The central bank signaled a willingness to continue normalizing monetary policy if inflation remains on track. Economists downgraded growth and inflation forecasts for China, raising concerns that the country may miss its 5% growth target for the year. This has led to increased expectations of further monetary easing by the People's Bank of China. Here is what to keep an eye on this week. That's a wrap for this week's Market Roundup. Thanks for tuning in. Be sure to subscribe and hit the bell icon to stay updated with the latest market news and analysis. Until next time, stay informed and stay ahead. I'm Daniel, and I'll see you next week.